All right. So here is, of course, the decision. We're going to start with Nigeria. Monetary policy rate retained at 27%. Bit of a tweak with the asymmetric corridor here, plus 50, minus 450 basis points around the monetary policy rate. Cash reserve ratio, that maintained at 45% for deposit money banks and 16% for merchant banks, and the liquidity ratio at 30%. Let's take a listen to Governor Olayemi Cardoso when that decision was made.
The committee decided by a majority vote to maintain the current monetary policy stance with an adjustment to the corridor as follows. 1. Retain the monetary policy rate, MPR, at 27%. 2. Adjust the standing facility corridor around the MPR at plus 50 to minus 450 basis points. 3. Retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and 75% for non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision was underpinned by the need to sustain the progress made so far towards achieving low and stable inflation.
All right. Let us have this conversation with our guests from Chapel Hill Denham and Afrinvest, Omobolade Agboola, Consumer Goods and Energy Analyst with Chapel Hill Denham, and Damilare Asimiyu, Macroeconomic Strategist with Afrinvest. Thank you both for joining us. Really appreciate you taking the time. Now, what did you make of this decision? Because there was a bit of a split. We had a wide range of analysts. Some suggested there would be a hold. Some suggested it was more on the cut side. So, let me bring it with you. What did you make of it?
All right. So thank you for having me, even though you didn't let me answer you. So thank you for having me.
Yes.
To me, it was a little bit of a surprise because at our side, we were expecting some cuts up to 100 basis points, because of how inflation has been, decelerating over the period. So we're expecting that there will be a cut. But it's a positive surprise. But we will not even say that there was no cut at all because of the adjustment in the corridor.
Yes, we do need to get to that. Damilare, your own take.
Thank you for having me, Rutus. I think my colleague has just hit the nail on the head. Yes, in our Afrinvest, we projected a cautious cut. We knew that the CBN, if there will be any rate cut, will not be very aggressive. We projected a 25 to 50 basis point cut. And the underlying reason for our cautious projection before, which in real sense the CBN didn't cut rate, was the fact that reading the body language of the current CBN governor and its team, they so much prioritize price and exchange rate stability. And of course, that is the primary objective of that institution, to pursue price and exchange rate stability. You recall that 5 months after coming on board of Governor Cardoso in September 2023, of course, in June, there has been a policy of liberalizing the FX market. But the fact that the CBN governor, we didn't get to know its policy direction on time and some other instability in the economy then, the exchange rate fell faster than it imagined. Because if you recall the Policy Advisory Council reports of the president, where they simulated what they think the exchange rate will be post-liberalization, the number they were looking at was around 800, 850. And that was even the number they used to build the 2024 budget initially. Later, they revised it. But within the space of 12 months, we saw exchange rate falling to as high as 1,008, even though the CBN governor and his team have started working then, but because of lag effects. So definitely, the Cardoso administration has learned from that one thing that the Nigerian market is still vulnerable to is what we call hot money.
Okay.
Because our organic source of attracting FX liquidity is still relatively weak. In our half-year outlook report, we estimated that given oil production of about 1.56 million barrels per day, an exchange rate of about, and a crude oil price of about $69, that the oil revenue that is supposed to account for about 50% of budget this year had underperformed close to 20%. The implication of that is the natural accretion to the reserve is weak. And of course, we've seen the reserve at 44, 46 level recently. It's a 30-day moving average, so we might not be able to tell the exact number. The last major jump came after Eurobond, we issued Eurobond, and plus some other blockage that the CBN has done. So definitely, while the CBN is driving everything with this in the handbill to ensure that the reserve is strong to support the Naira, the organic sources, producing more oil, expanding, yes, non-oil export has improved, but not at the pace that if you look at growth rate of our non-oil export compared to Ghana, we are trailing significantly. So looking at those risk factors, the CBN knew that tweaking with policy rates too much might dissuade these FPI guys, who in Q1 this year alone brought in 5.6 billion. That is the highest since pre-COVID level. And at that rate, it means we might have our foreign portfolio flow this year running to about $20 billion, which is a level we last had or saw in 2019. And that counts a lot for FX stability or price stability. And of course, when you have price stability, because Nigeria is an economy where people import a lot, including machineries, right? It helps businesses to plan. My colleague were discussing that before coming on set. PMI expanded consistently for 6, 7, 8 months, reaching 54 points in the recent reading. That is one of the highest in recent period. So these are the factors that inform the decision of the CBN to go cautious, because you need that hot money to maintain price stability, which is fueling disinflation that we are enjoying now.
All right. Now, thanks to that, Damilare. The impact of this, I guess, hold, or we can talk about the benchmark rate, the impact on individuals and businesses. We have to talk about how the average Nigerian is impacted by all this. How do you see that dynamic working out?
I think it's a little bit of a relief. Of course, not a huge relief, but it's a little bit of a relief, because if we look at although there was a hold in the monetary policy rate, but if we look at the asymmetric corridor now, previously it was plus 250, minus 250. Plus 250 will mean that banks will be borrowing from the CBN at 29.5%. And but now, because of it's now plus 50 basis points, they'll be borrowing at 27.5%, which is a little bit of a relief, in terms of them borrowing, and then also giving to individuals and businesses. Of course, it's still double digit, it's still high, but it is better than what it used to be. And if we also look in terms of them depositing with the CBN at minus 450 from minus 250 before, so it's also positive for them, because even for prime lenders can negotiate better interest rates in terms of their borrowing, unlike before that they'll be contending with 25.5% that they can get from the CBN, but now it's 22.5. So if a borrower can give me 24, I'll still take that compared to keeping my money with the CBN. So it's a little bit of a relief, although we are still in high.
On the high levels.
We are still on the high levels.
Damilare, what are your thoughts on what the average, I guess, on what how individuals and businesses will be?
Yeah, I mean, she has spoken well. I mean, the effect of the tweak in asymmetric corridor will follow an indirect path, unlike if it was the MPR that was cut, because a cut in MPR will have had an immediate trickle effect on money market rate and everywhere. But this is just asymmetric corridor that was tweaked, and only the banks play in that window. So raising the negative end of the asymmetric corridor means that banks deposit their liquidity with CBN will only get about 22.5% rather return, right? Closing the margin prior to now, it will have been about 24-25%. So just like he said, it's not the implication of this is that there's a maximum amount the banks, because now the reducing of the upper bound also means a bank also can borrow at relatively cheaper rates compared to 29 before from central bank. So the gain here now is that rather than placing all the money at it, the banks with excess liquidity are placing at 22.5 with the CBN, prime lenders can take advantage of this. And of course, because the prime lenders also can negotiate better now at a rate that will be at least slightly lower than what they get before. On average, prime lenders are taking about 26, 27 before, when MPR and when Asimiyu corridor was 250 positive and 250 negative. So now they can negotiate it down. So you talk of people like Dangote, the prime lenders getting at that rate. So the implication of that is the aggressive nature of those guys going to issue commercial paper might come down a bit, because beyond the rates or coupon they offer on commercial paper, there are other costs that is associated with them. But when they have banks that they deal with, they can easily take overdraft, they can easily take some short-term liquidity to support their business without going through processes that cost them more. So they can negotiate that now, given the fact that banks themselves now have a slight relief in terms of borrowing, and they are more incentivized to lend it to prime lender rather than the CBN, because the rate on the CBN side is not as juicy as it is. And if they want to come to the money market, treasury bill, of course, treasury bill is about 16% now. So definitely major operators, prime lenders who are business focused are like the one that will help us get the trickle-down effect of this in the mid to long term. It won't be spontaneous because it's not MPR, but it will have a mid to long term effect on the economy. Okay, great. I'm glad you mentioned commercial papers and treasury bills, so money market, and I do want to get to money market and fixed income, but I do want to touch on the equities markets before we get there, because we did see the stock market at least snapping its losing streak today. 0.1% gain today. So for the all share index, what were we, 143.7? Yeah, so up 39.6. What are your thoughts from both of you on? Don't have to spend too much time on this, guys. I do want to get to the other matters, but any quick thoughts on the impact of monetary policy on the equities market? I guess lower rates, well, the rates is still being held, but I guess maybe that's, if you look at this publicly traded companies that are there, what are your thoughts on any transmission or any effect, if at all?
Oh, okay. Theoretically, one would expect that when we have low interest rates, the equity markets will, perform better, and then vice versa. But if we look at our economy, our markets in the past 2 years, this has not been the case. Last year, where we saw interest rates as high as 20%, equity markets still delivered strong returns, and even banking stocks amongst any, other sector, right? So I don't think it's straightforward for us here in this market, and it's just because of the peculiarities in our own economy. And so I don't think there's any straightforward correlation with that. And with the markets, gaining 1 basis point today, I think it's positive. It's good because because most of what has happened recently is not necessarily that companies that are listed on the stocks are not fundamentally sound. The stocks are fundamentally sound, and they are actually trading below what we'd expect them in terms of valuations. So I think that it's just a beginning. It's a one-day thing, and we would like to see more. Thanks.
Damilare, I really want to jump because of time. On the fixed income side, let me get your thoughts on, since you already mentioned commercial papers and fixed income. We already had a bond auction, or a reopening yesterday, I think, and then we had it on the 19th, a T-bill, Treasury bill auction. So what is this? What's the impact for fixed income, and so this was at 19th, on the 19th. Stop rates 15.3. Yeah, so stop rates did come down. Okay, so stop rate for the 91 day was not changed at 15.3. For the 182 unchanged as well. So this was on the 19th though. So going forward, so these rates were not changed. Well, going forward, do you see any impact on I guess money market and fixed income rates?
The reality is that as inflation continues to moderate, the market dynamics will mean that market rates should correct downward. Now, if you look at the recent auctions you're talking about, the NT bills auction and the bond auction, you see there is massive oversubscription on the long end of the curve.
Right.
The implication, or what is driving that, is that big money bags or large portfolio investors knew that the high rate we are currently enjoying now will not last.
Right.
So for as many of them that have the liquidity that they can tie down for long, because if you scenariolize Nigeria inflation outlook over the next 12 to 18 months, what you see, aside for December, that we are expecting a major spike. I mean, this coming December inflation, we are not expecting it to be below 28 and above because of the base year effect of the rebasing. But if you take that one away, on average, inflation this year will be around 21 point something. And from February, March next year, when the rebasing thing properly normalized, what you see is inflation correcting downward further. So what that means is that market pricing of coupon would temper. And because of that dynamic that is expected, except for a major shock on the economy, then yield will correct downward. So because of that natural expectation, people are trying to lock in now. And that's why most of the interest are on the long end.
True.
17, 16.5, 16.9, people want to lock in down, because when you look at the fact that inflation is reducing, what you have as real return in 3, 4, 5 years, if inflation continues at this trajectory of disinflation, is a strong return. And I expect that this will persist irrespective of whether the CBN didn't cut rate now, because even though the CBN didn't cut rate now, there's still a signaling undertone in what they did. They tweaked the asymmetric corridor. Remember at the last meeting, they reduced the cash reserve ratio from 50. It used to be 32. But part of policy tightening measure by the Cardoso administration was to move it from 32.5 to 50, reduce loan-to-deposit ratio reduce the loan-to-deposit ratio as well, so that banks are not just pumping liquidity into the system. So they've achieved the first phase of their objectives. So the second phase now is to now ensure that, you know what, the little tweaking we are doing now, because we don't want to lose the FPI, but yet want to signal that we know that at this point, with the movement into inflation and the strong GDP growth in Q2 4.23, we should be lending more to the economy, though gradually and to the right sector. So because of that, coupled with the fact that inflation outlook looks positive in terms of deceleration, fixed income market will continue a bullish trend in near term. Okay,
great. Now, you've mentioned inflation. I want to get both your thoughts on the deceleration we've seen now for the past 7 months, and you've already talked about the FPIs and how important it is that they keep coming in. So I guess your thoughts on the inflation trajectory that we've seen so far. Is the stable currency the key thing here to keep that trend going? What are your thoughts on how?
I think it's very important to ensure that we have a stable currency because of the dynamics of our market. But I don't think that that's the only thing that we should be focusing on. There are other important issues as improved security and also better infrastructure, because those are the things that will drive output for the economy, and that is positive for growth, and that would ensure much more domestic price stability. Exchange rate stability is very important, but I think that it is not only that cannot solve or cannot sustain this inflationary trend going forward.
No, please take a swing. We have our chart here.
What she has said. The strong disinflationary trend we have seen in the last 7 months was driven by more factor than just the stability. The stability is very important. It is central, because when the purchasing power of a currency is going down, right, it means people need to look for more money to buy a certain quantity. But more importantly, or other supportive policy are some of the things that the fiscal guys did. You recall August last year, during the time that food inflation crossed 32% for the first time, the federal government then planned to implement a policy of removing tariff and what have you on food items, and even opening some of the remaining land borders fully. They didn't do that on time, but by April, May this year, they did that. And if you look at the movement in month-on-month inflation since April, May, it has been very consistent in terms of disinflation. Prior to that, we have a month-on-month of 4%. In fact, we had 10% in January due to statistical imbalance from the rebasing. We had about 4%. But from March, April, it then fell to 2%, and then it narrowed down to 1%. So any month-on-month inflation below 1.5 is decent in Nigeria's situation, because a 1.5% month-on-month inflation will give you an annualized of 18%. So anything below that means that you have inflation correcting further downward. So the stability in the currency for the for the part of our economy activity that is exposed to importation, plus the fact that the government has now removed tariff and some extra cost on importation of food and reopening the land border, these are the factors that are still playing, because even with the rebasing, food still constitutes about 41% of the CPI basket.
We just want to add to that. Food deflation, what we're even experiencing on a month-to-month basis in the food index is deflation, not even disinflation. It's negative growth month-to-month.
Point well made. Point well made. Really enjoying the two of you here. Okay, so as far as maintaining the stable currency, is it going to be about and Damilare, you did touch on this in the beginning, but is it going to be about the FPIs and juicy Omo rates? What's going to keep that going?
So we need them. Actually, we cannot even. So we need them, and they are, and honestly, it's a short-term look. It's only short-term. It cannot go for long-term. What we need in the long-term are foreign direct investments that would employ people, that would ensure that we are increasing our outputs and in turn translate to economic growth. The central bank governor can do his best based on the tools he has currently. So in the long term, to ensure exchange rate stability, there is a need to look beyond foreign portfolio investors.
Looks like we're looking at the fiscal side of the coin, eh? Damilare, to us.
I agree with her. There's a saying that even in Freetown, nothing is free. When you have a turbulence in terms of your currency, you have turbulent currency experience, you may want to employ short-term measures such as incentivizing FPIs to bring in their capital to drive liquidity and maintain exchange rate stability. But when we're talking mid to long term, just like she has said, because for every we're talking about a rate of 15-16%, and that's why I said as long as we are still within this rate, before rate will crash further to 12-13, the FI market will still be bullish because it's a very attractive rate compared to peer market. So meaning that the bank will pay interest rate of that magnitude. Let me use the fiscal gas as an example. This year alone, as of the first half of the year, the government overshoot its pro rata debt servicing cost. Debt servicing cost budget for this year was about 16 trillion. So pro rata as of half year is supposed to be about 6 trillion. We overshoot that by more than 10%. What that means is that the more you have a high rate, the more interest you pay. So they are short-term fix. We need it now because we need to stabilize the economy. But beyond the stability, you recall I mentioned that the accretion in the reserve now are not mainly from organic sources because the organic sources are not pulling their weight. We have a oil production benchmark of 2.0 million barrels per day this year. The average we have done thus far, even plus condensate, still sits around just 1.61. So meaning that there is a gap in production, and the international dynamics also is not playing in our favor. We have oil benchmark price of $75. The average thus far this year is about $68. So there's a shortage in the price, there's a shortage in production. You don't need any prophet to tell you that Nigeria's oil revenue is currently underperforming, which put more pressure on the non-oil, and of course we are seeing some of the reforms that are ongoing. So definitely, and if you look at our merchandise composition, oil exports accounts for about 85% of FX inflow. So that's a major source that is suffering. So because of that, you can bring in FPI now as a stopgap, but we need to be doing all what we need to do to attract FPI. Nigeria used to be the preferred destination for FPIs in 2014, 2015. The likes of Egypt and South Africa numbers used to look at Nigeria's numbers very tiny. But now, bulk of FPIs are going to Egypt, South Africa. We need to get our fundamentals right. We need to address insecurity. We need to make the business environment more accommodating so that FPIs, which is patient capital, can come in, employ people, and naturally sustain our exchange rate.
All right, excellent. Now, guys, guy and girl, the outlook for fourth quarter. This is the last week in November. We're heading into the dirty December period, and I guess after rebasing, we had GDP of 3.7, right? Yeah. So for fourth quarter, so how do you both? You're in the consumer goods space as well, right? So how do you both? I see this fourth quarter playing out.
So I think that it's going to be better, way better than last year. And this is because if you look at the PMI, it's starting off on a strong note.
Yeah.
As of October 2025, it was 55.4 points. That's the highest in like 11 months. So it's starting off with a strong note. And at Chapel Hill Denham, we forecast a Q4 GDP at 4.69%, definitely better than 3.76 of last year.
Yeah.
And that will bring full year growth rate, GDP, to about 4.2 or 4.16%, which is better than 3.38%. So this year has been good in terms of economic growth, and we expect that, going forward, especially because of some of the reforms that have been done in the oil and gas space, agricultural space too, because we also saw improvements in the agri sector, line item. So we think that, it's good, and this Q4 will be solid results compared to last year.
Damilare, final word from you on your outlook for Q4.
Yeah, I mean, our expectation for Q4 GDP is also solid. We think in a base case scenario, Q4 GDP number this year will range between 4.3 and 4.5. The implication of that on the overall growth for the year, because for the Q3 that is yet to come out, which we're also expecting, we're seeing it at between 3.7 and 3.9. So overall, based on the dynamics we have seen, we think that full year numbers for GDP will be between 4% and 4.1, which will be perhaps one of the strongest in the last 4 or 5 years, even with the rebased number. So definitely we are very optimistic. The numbers, the indicators are showing. When you look at the Q2 GDP composition, you see some sectors pulling strong weight. Oil refining used to be a deficit segment, in that GDP, but since Dangote started producing, and now he's increasing capacity gradually, he's maxing up his current 600 million barrels, maxing it up and planning to even expand. Now, since Q3 last year, rather, when it started operation gradually and expanded, that sector has been churning out strong growth. It did about 16% in Q2. So you think that those kind of improvements, plus the fact that stable currency has now supported consumer goods sector. You recall when I came here to discuss the brewery sector in February, I said bouncing back to profit. Yeah. And that is telling, because the sectors now have stable exchange rate, they can now plan better, and they're able to penetrate markets, and it's counting on numbers. So all this together, plus a dirty December that will not be dirty, will give a stronger GDP performance in Q4.
Damilare Asimiyu, Macroeconomic Strategist, Afrinvest Research and Consulting, Omobolade Agboola, you're over at Chapel Hill Denham, Consumer Goods Energy. Thank you both for taking the time to talk to us about the MPC decision, and of course, looking out on the wider economy for Nigeria. Really appreciate your time.